Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello, everyone, and welcome to another edition of Views from the Street, where we bring you insights from market leaders and industry veterans on how you should position your investments. In today's episode, we have a special guest with us, Mr. Suyash Choudhary, Head of Fixed Income at Bandhan Mutual Fund. Welcome to the podcast, Suyash.
Thank you, Ravi. It's great to be here, and I look forward to this conversation.
Well, just to get started, the fixed income market has been quite volatile globally. But when we see the Indian fixed income market, it has been relatively stable. What's driving that?
I will take you back a bit to the post-COVID response of monetary and fiscal policy, because we think that had a great role to play in the kind of macro stability that we are seeing today. So, what you saw in the post-COVID response is that a lot of developed markets, chiefly led by the US, were very aggressive with their fiscal and monetary response to the crisis. Now, part of it was because they could afford to, because they were printing reserve currencies of the world. And partly because, there was probably a misinterpretation of the economic aspect of the problem. So you remember it was really a seizure of activity. And therefore, a lot of economic collapse that you saw was simply because physical activity was not happening. And what was required was to shore up the weaker balance sheets for both households and businesses, and not probably an very large and very, very aggressive fiscal and monetary response of the order that developed markets ended up doing, chiefly the US. Now, if you see on the other hand, India stitched its fiscal and monetary response exactly to the problem, aware that it was an emerging market and therefore had a certain boundary for macro stability that it had to respect. So we expanded our fiscal program, we cut rates, we loosened liquidity. But when we deemed the crisis to have stabilized, the government rapidly embarked upon a fiscal consolidation path, and the RBI normalized monetary policy. This was very different from what happened in the US, where, like I said before, the fiscal response was aggressive, but the fiscal consolidation post the crisis blowing off is also been very reluctant. So the budget deficit in the US still sustains in the 6 to 6.5% of GDP area, which is quite remarkable, for a peacetime economy that is doing fairly well at GDP level. So the Fed's task has been harder. They have had to raise rates very substantially, thereby injecting more volatility into their bond markets also, because they couldn't help it given the size of the fiscal response. On the Fed's part also, especially with the benefit of hindsight, you could argue that the quantum of monetary easing and the delay in tightening would have also contributed somewhat to enhance volatility in the marketplace. So this, we think, explains a lot how, some emerging markets, notably India, have been relatively calm for bonds over the last couple of years, whereas more volatility has been imported from developed markets like the US. This also partly explains how interest rate differentials between the two systems could be so narrow, and still capital flows have been broadly fine, barring episodic risks that you have seen over the last few months.
Well, that said, I get your point on how the RBI and the government were able to manage stability in the fixed income market. But if we look at the last 12 to 18 months, there have been certain tailwinds that the Indian government bonds have enjoyed. But at the same time, we've also seen volatility in the last 6 months. What's been driving that?
So you see, over the last couple of years, you have had 2 or 3 times when you thought either the US economy is slowing or, there is some financial risk building. So what you've seen, Ravi, over the last couple of years is that you have had a few episodes, chiefly in the US market, where you saw either growth-related concerns emerge or financial market stability-related concerns, but they were quickly dusted off, and you found that they were actually false alarms. Responding to these concerns, bond yields fell briefly and dollar index weakened, only to retrace everything that they had lost. So long story short, a lot of volatility that India bond markets have experienced over the last couple of years, whatever they have been imported because of volatility in the dollar index and US rates. Let's take the last phase, which is from September last year. And there was an element of local factors there also, so that bears a bit of a greater scrutiny. So after September last year, we saw the same story in the US. There was a brief period where we thought inflation was coming off and growth was slowing, only to find that was false. Growth rebounded in the US, inflation concerns came back. and a lot of rate cut expectations that were built in got unwound. So you remember that US 10-year bond yields around September had fallen all the way back to 375-ish, and they rose almost 100 basis points over the subsequent few months. And that obviously injected a volatility in India markets. What also happened during that time, consistent with US rebounding, is the dollar index strengthened and the rupee weakened. And the RBI had to intervene very strongly to maintain some bit of stability in the exchange rate market. One of the outcomes of that was, when RBI sells dollar to the market, it buys rupees, and therefore system rupee liquidity gets destroyed. Because the quantum of interventions over those months was very strong, we saw a massive amount of rupee liquidity destruction between October to December. And by January, what we call as core system liquidity had actually turned negative. So India bond market in that period had two headwinds. One was global volatility. The second is extremely tight local liquidity conditions. However, if you assess where we are at today, both these factors are unwinding. So US growth on the margin has slowed. Growth expectations have come off, which is both because of policy uncertainty as well as some of the recent growth drivers beginning to weaken. Simultaneously, the RBI has done a very strong job of creating INR liquidity. In our estimate, close to 6 lakh crores of permanent or semi-permanent liquidity has been infused over the last 3 months through FX swaps as well as OMO bond purchases. So as we speak, you sit at a point where some bit of rate volatility globally has subsided. As we speak, US 10-year is back to 4.2%. And locally, system liquidity has been shored up through proactive and aggressive actions by the RBI. So this last phase of bond volatility also hopefully has stabilized for now.
One factor that had been a tailwind was the government bonds or Indian government bonds inclusion in global indices. And that happened, the announcement came somewhere in September of 2023, and we've seen some positive flows continuing. Is that likely to be a supportive factor going ahead?
So look, the direct component of index buying is largely behind us, which means that, the gradual time period over which index inclusion had to happen ended in March of the financial year that just closed. However, we think the FPI participation in the India bond story is a much larger format that you have to think about. So, India, as we all know, and speaking to FPI clients, that further reaffirms that fact, is one of the best macro stability stories around the world. You have a very conservative or a appropriately conservative, fiscally conservative government. You have a traditional RBI that respects inflation targeting. You are now the 5th largest market GDP in the world. And you have very low FPI ownership of India government bonds. So FPI ownership of central government bond outstanding is just about 3%, which is, if you think about any comparable emerging market, it's actually very, very low. Something like in Indonesia would have something like 17-18% FPI ownership of government bonds. So we think there is miles to go for FPI ownership to continue to enhance for India government bonds, with sporadic interruptions from time to time owing to global factors. So we are quite hopeful that over the next 2 to 3 years, FPI ownership should at least double as proportion of government bonds outstanding, should the current macroeconomic format for India persist. And as of now, we have no reason it won't. So government continues to affirm that it is first and foremost thinking about macroeconomic stability, and so does the RBI. So we are quite hopeful that even with the direct bond index inclusion flows behind us, the FPI ownership stories continues over the next few years.
Well, with that background in mind, what should an investor do in the current market scenario? Where are the opportunities in fixed income markets?
So look, something we have been saying now for the last 1.5 years is that the number one risk investors have to, kind of hedge against is reinvestment risk, which is the risk that as maturities come in, you find that you are deploying them at lower and lower interest rates. Now that phase is well and truly begun for India. You're already seeing a lot of market determined rates, falling. We still think there is time to build a portfolio that safeguards against reinvestment risk. That will entail running some amount of duration, whatever you are comfortable with, because by definition, that is the factor that will hedge against future reinvestment risk. Now again, duration does not mean long duration or active duration for everyone. Duration could simply be a 2, 3, 4 year maturity, as long as you have thought through what kind of risk appetite you have and how much of reinvestment risk you want to plug. In terms of market opportunities, look, the two things that we have liked a lot over the last few quarters. One is duration via government bonds, because we think the demand supply story is the best as far as central government bonds are concerned. So we like government bonds for duration. And we like the corporate bond curve, largely the front end, up to 2-3 years, because the corporate bond curve has been severely inverted. So therefore, yields up to 2-3 years have been much higher than yields at the 5, 10, 15-year points. However, that is now slowly correcting. And as the corporate bond curve resumes its normal shape, then it may become appropriate to go towards mid-duration points on the corporate bond curve as well. But in summary, what we really like is duration via government bonds and the front end of the corporate bond curve. Plays on this include a host of products, including active duration for duration, or products like short-term corporate bond, banking PSU kind of products to play the corporate bond curve. Obviously, each product will have a different strategy, so investors should be aware which scheme class is pursuing what strategy.
Thanks, Yash. Now, whatever we've learned so far has been most of the positives broadly, but what are some of the risks that investors should watch out for in the coming months?
So first of all, one should not make the mistake of thinking it's a sanguine global environment. It's not. We are aware every day there's a different headline. Now, one clear risk on the table is, if there are aggressive tariffs and they generate near-term inflation, then the task of central banks will become that much more complicated. For emerging markets like India, this recent stability in capital flows can very easily get jeopardized if globally risk of sentiment were to take strong roots. And third is, how local policy reacts to a growth slowdown, if such a slowdown is coming owing to global volatility. However, that said, one should also, kind of assign some balance of probability to each of these risk factors. So, the tariff-related inflation probably will have much more impact in countries like US, that much lesser in India. And even in the US, probably, you will be able to see through the one-time price shock so long as it doesn't become sustainable. The risk to capital flows for emerging markets like India is real if the global growth outlook were to deteriorate sharply, and that is something we'll be watchful for. The third risk factor with respect to local policy, we are much more comfortable with, because we have seen this government and this RBI through the COVID phase and the post-COVID phase, and we think they are very serious as far as macro stability is concerned. So we don't worry about any sort of missteps on policy as far as government and RBI are concerned.
Thanks, Yash. That was very informative, and it's always a pleasure catching up with you.
Thank you so much, Ravi. It was a pleasure being here.
Thank you, everyone. And that brings us to the end of the podcast. Thanks for listening. And if you enjoyed this podcast, please like and subscribe.
Thank you so much. Look forward to seeing you again.
Yes, always a pleasure.
Bye.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.